Options traders, welcome back to Trend Tracker. Today we are breaking down one of the most powerful, adaptable, and misunderstood option strategies out there, the 143 butterfly strategy. I have already closed this trade for a profit of about 30%, but for the sake of education, let's reopen it and break everything down step by step. This way you can see exactly how the setup worked, why it played out the way it did, and how you can apply the same logic in your own trading. Before we dive in, if you haven't watched my previous video on the 143 butterfly, hit that link in the description. In that video, I walk through the essentials, including what the 143 butterfly actually is, why it outperforms many traditional butterfly setups, how to structure the trade step by step, ideal entry and exit conditions, and the logic behind why this asymmetric design works so well. That video lays the foundation, and today we're building on it. Alright traders, let's break down this trade, my 143 butterfly setup on the SPX. I opened this trade on December 10th, 2025 at around 3:40 p.m. just minutes after the Fed announced a 25 basis point rate cut. Now let's pull up the SPX chart on TradingView and jump to that exact moment. Around 3:40 p.m. SPX was trading near 6,890, hovering right around the 6,900 level, which at that point was an all-time high. Even though the Fed cut rates, the market had already factored that into its expectations. There wasn't any real surprise, and price action reflected that. Strong levels, but no real momentum to push higher. Here's what I was thinking. We were sitting at all-time highs. It was the mid-December holiday season, with lower volume and thinner liquidity. The market had already reacted to the Fed decision. And historically, after a big run-up into year-end, SPX often cools off or drifts sideways. So my expectation wasn't a breakout. I was anticipating a quiet market, maybe some sideways consolidation, or even a slight pullback over the next few weeks. And that environment is exactly where the 143 butterfly shines when you expect the market to stall rather than explode. Before we dive in, a quick reminder. Always start with paper trading before placing real trades. It's the safest way to sharpen your skills without risking your capital. If you enjoy our content, don't forget to share, like, and subscribe so you never miss our upcoming videos. So here's the trade I put on, a 143 put butterfly on SPX right after the Fed announcement around 3:40 p.m. on December 10th. I deployed this structure because the market was stretched, volume was thinning out, and the setup aligned perfectly with my sideways to slightly down thesis. Let me walk you through the exact trade setup structure. I bought one put at 6,900, sold 4 puts at 6,740, and bought 3 puts at 6,700. So this created a really attractive risk profile. Max loss is about $2,200 and max profit is roughly around $13,800, which is very rare and possible only if SPX trades around 6,740 at expiration. The probability of profit is around 48%, which is very good. Delta is roughly -9 to 10, so slightly bearish but not aggressively. Directional risk to reward is better than 1 to 6, which is exactly what I want in a butterfly. This is the kind of setup I love: small, defined risk, big potential payout, and a structure that benefits from the market not doing much. I usually place these trades 30 to 45 days out, but I rarely hold them to expiration. My goal is to take profit or manage risk within 1 to 2 weeks, depending on how the price and volatility behave. Let's talk about what happened after I entered the trade. The very next day, December 11th, the market did exactly what I expected. It pulled back. My 143 butterfly was already up around 20% in just one trading session. I could have taken the quick win, but based on the setup and the momentum, I decided to hold. See if there is a bit more downside. On December 12th, SPX continued drifting lower and started hovering around the 6,800 level. At this point, my position was up 30 to 35%. SPX wasn't breaking below 6,800 and the price action was slowing down. That told me the move was losing steam. So I followed my plan and closed the trade for a 30% profit. Could I have adjusted the butterfly to chase a bigger payday? Absolutely. There were a few smart adjustment paths available, but I stuck to my predefined exit rules, and that's what keeps traders consistent over the long run. Discipline beats impulse every time. I'll break down the adjustment strategies for this setup in a separate video. Had I stayed in trade a bit longer, I would have made an even bigger profit. SPX was bleeding next few days and reached levels of close to 6,700. Let me show you the whole strategy value for next week. We bought at 22 levels and exited around 30% profit at around 29 levels in just 2 days. But strategy value had gone up to 40 levels, which is almost 80 to 90% gain on our invested capital. But you have to stick to your plan and keep all emotional thoughts on the side while trading. The 143 butterfly setup works perfectly on major markets like SPX, NDX, mega cap stocks, and really any highly liquid global index. If you like strategies that give you structure and flexibility, this one deserves a spot in your playbook. The 143 butterfly isn't just another option setup. It's a framework for managing risk and reward with precision. It's powerful, beginner friendly, and extremely effective when used with discipline. With defined risk, a wider profit zone, a market flexible and easily adjustable, this option strategy should be your next go-to strategy. If this breakdown helped you level up your trading game, go ahead and hit that like button, subscribe for more smart trading content, and drop a comment if you want me to dive into more advanced option strategies. Until next time, trade smart, trade safe. Thanks for watching.